Welcome back. The next company on our radar right now is Bansal Wires. Now, the reason we're talking to them is that some of the brokerages are getting bullish on this stock, citing that one, there is a capacity expansion underway, and two, the company is also targeting some high margin businesses, so getting into steel cord, etc. So that could potentially boost the margins going ahead. Pranav Bansal, the managing director and the CEO at Bansal Wire Industry, is now with us on the show. Pranav, thank you very much for joining in. Before we get chatting about, the two things I spoke about, just talk to us about FY26. Do you maintain the 25 to 30% volume growth, and what are you likely to do at the EBITDA and PAT level this year?
So our guidance for this year is definitely the same. We will try to do our best to get a 25-30% kind of a volume growth. The market is good for us today. We see good demand coming from our customers, so that should not change. Similarly, EBITDA should also increase. We are looking at some product mix change, of course. We will have more low value added products that we will be selling this year. So our EBITDA should also increase by about 10% also this year.
That should increase by?
10%.
Okay. EBITDA, the absolute number will increase by 10% is what you're saying?
Absolutely.
What will the margins look like? What will the margins look like since you're looking at adding more value-added products? How much will that be as a percentage of your overall revenues by end of this fiscal year?
So by end of this year, we are looking at 20-25% of our revenue coming from high value-added products.
Okay, and what?
As and when we add capacities for products like steel cord and other high value added.
So what does that do to your margins?
Gradually, over a period of 3 to 4 years, I think we are looking at some margin expansion. In terms of EBITDA per ton, we are looking at about 6,500 rupee level this year, which should gradually go up to maybe 8 or 9-ish kind of a number in the coming 4 years.
So, Pranav, just explain. Volumes will go up 25 to 30%. What will the revenue go up? Because your EBITDA growth is only seen at 10%.
Revenue might not go up by the same number because, again, revenue is all a matter of my volume. The kind of product that we sell gives us a very different kind of a revenue number. This year, our thought process is to sell more of low value added products, increase those numbers more. Therefore, revenue might go up to about 20-25%. But all of this depends on the raw material prices.
But then shouldn't your EBITDA go up if your revenue at least goes up by 20%? And you're focusing on some high value, then shouldn't the EBITDA growth also be at least more than 20%? Why are you guiding only for 10% this year?
So we have taken a 3-year strategy, wherein this year our thought process is to capture market share, which we have not been able to in the last 2 years because we did not have much capacity. From this year, because of the new facility that has come on stream, we are targeting a higher volume growth, and we will be a little aggressive in terms of our margin profile when we sell. Next year, however, we will try to bring that number to the same level of revenue growth. And the year after that, which is FY28, with our backward integration initiative and with the high value added products, this will further improve. So this is the 3-year plan. The first year is volume growth, second year is stabilization, and third year is going to a new and a better number.
A couple of questions, Pranav. You mentioned that you are aiming for a change in product mix towards more value-added products. Which is the segment that you would pay more emphasis to? Because currently, auto is the bigger segment that contributes to your mix, followed by infra and then engineering and then durables. Where does the mix change? And part 2 of my question is, you had also spoken about gaining market share. What is it currently and what are you aspiring to achieve?
So in terms of market share, in FY24, we were at about 6%, 7% kind of a market share. We are looking at grabbing a 10% market share in the next 3 to 4 years, whereas the industry is growing at about 8 to 10% as well. In terms of product mix, we are looking at steel cord and some other specialty wires like induction tempered wire and oil tempered wires to contribute to a better margin for us. Similarly, in terms of industry also, I think the main focus will still be automotive, which is our largest end user even today. That share should go up,
So,
which will drive.
Yes. Pranav, you're saying specialty wires will be a big driver in coming times. You said the margins are higher as well here. Is it already there in the value-added products mix that you told us about? Plus, when we say the EBITDA margins are better, how much better are they? Because one of the brokerage notes suggests it could be 20 to 30% versus 4 to 6% for commoditized wires.
So again, for us, how we look at our margins are more on return ratios. We target a 20-25% kind of an ROE earlier. Now our target for ROC is 20-25%. So any product that gives us 20 to 25% ROC for us is the right product. In percentage, it might be more or less in terms of percentage of revenue. Specialty wire also in terms of ROC would be similar. In terms of absolute EBITDA percentage, it might be at that range.
Okay. Very, very quickly, Pranav, what's the progress on your new products, steel cords? Very quickly.
So steel cord is going good. Our pilot project is already underway. We started production. Samples have already gone to some customers, and we're waiting for approval, which will come to us in the next 12 to 15 months.
All right, Pranav, thank you so much for sparing time joining us today, and wish you good luck for the rest of the year as well. We'll take a short break, but just before we do that, here's some good news for our viewers. India's business news leader is now just a click away, and that is CNBC-TV18's all-new app, where you can get access to instant news, breaking news, in-depth articles, and financial world updates right at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up in just a bit on your screens to download the app on your phone. Take a short break, and we'll be right back on the other side just as the QR code appears on your screen.